Professor Richard Wolff is very concerned that because the economy got fixed after 2008 using a completely different method than FDR used in 1933, that the Republicans have set us up for a real disaster. Check this out. Leave your comments. Ding the bell, share it with your friends, and please subscribe to our channel. On the line with us is our old buddy, Professor Richard Wolff, the economist, co-founder of Democracy at Work, author of numerous books, including his most recent Understanding Marxism, which we just added to our lineup of Thom Hartmann Book Club summaries, or teases, or tastes, or samples, or whatever you want to call it, which will be up on YouTube in a day or so as well. And Professor Wolff, welcome back.
Thank you very much. It is flattering that you were reading from my work. I'm much obliged.
Oh, it's a damn good book. I wanted to talk to you about the Fed, and I believe that Sean shared this Axios Markets newsletter with you that I got this morning.
Yep.
Where they're going through, and Dean, I'm not sure how he pronounces his name, Raboin or whatever, who does the newsletter, goes through and points out that basically the Fed has been just pouring cash into the markets, and what we find increasingly is that prior to the Trump era, everybody thought that there was no connection or no explicit connection between Fed activity and stock markets. Although the fact that LBJ lifted Fed Chair Miller up against the wall by his throat and took it on his tippy toes and yelled at him for raising interest rates just before an election, I guess indicates that it's been a long-held secret. But, the average person didn't realize that the Fed actually could swing markets and thus get presidents elected or not reelected. But the Fed has been just pumping cash. I mean, their total assets of the Federal Reserve right now are at $4.16 trillion. Our GDP is only $20 trillion a year. What does that mean? And where does that money come from? And what happens if the Fed stops this stimulus? And why is this even happening?
Well, that's the key question. So let's start at the end. Why is it happening? In 2008, we had the second worst crash in capitalism's history. That has to be the starting point, literally, for all of these analyses. It was bested, or worsted is the better word, only by the Great Depression from 1929 to 1941. This was a collapse, and it was global, of capitalism as a system. It freaked out all of the leaders of capitalist countries. Those last 4 months, September, October, November, December of 2008, were times of all-night meetings at the Federal Reserve in Washington and New York City, in which a desperate group of bankers and their associates tried to figure out how to prevent a full-scale collapse of the American economy. And by a collapse, I don't mean something you read about in the newspaper, but something you notice when there's no milk on the shelf in the supermarket, when there is no way to get your telephone to work, and all the other signs of social collapse. And one of the things that was decided at that time was that unless things were done in an extreme way, there'd be no tomorrow for the debate about what we should have done. You simply have to try everything. So here's one of the things we did. We gave to the Federal Reserve a basic direction. They would have taken it even if we hadn't. But as a nation, the president, Bush at the time, then Obama, they were no different on this stuff. They told the Federal Reserve, do what has to be done. Print money like you never did before. Create bank accounts for all the banks. Simply put numbers into the account and allow the bank to act as if that were its own money to make loans, whether it be to corporations, to governments, to households, it didn't matter. Flood the economy with purchasing power in the hope that by doing all of that, you could stimulate, that's the word they used, a stimulus program to get the economy going again. And what has happened in the decades since has been that we have become an economy utterly dependent, sort of like life support for a very ill person, on this continuous infusion of costless, low-interest, tons of money. The Federal Reserve buys securities in the market. That's what it calls when it accumulates assets on its balance sheet and so on, in order to juice the economy, because if you leave capitalism to itself, not only do you get the crash of 2008, but they have now determined it is simply too dangerous to take the patient off. For a short time, this is my last point, for a short time, in the last 2 or 3 months of 2018, they decided they had pumped so much money in, they had to pull some out. They did that, and the stock market took a dive.
Right. In fact, so much so that for the entire year, the investors lost money no matter what they invested in.
That's right. And President Trump got freaked because he could see that if he lost the business community that he had won over with his tax cut in December 2017 by a bad stock market, he could kiss his reelection goodbye. So he went to work on Mr. Powell, got the Federal Reserve not only not to raise interest rates, but over this last year to lower them, not to end what they called quantitative easing, buying shares. Mm-hmm. They reversed it and started selling, buying again instead of selling. So you had the resumption during 2019 of the life support infusion of endless money, and so the stock market did well in 2019, and Mr. Trump feels confident that between his base in the evangelical communities and elsewhere, and the big business money, he can have at least a reasonable shot at re-election. It's a sad story because the history of capitalism, if it teaches nothing else, teaches us that the longer you delay the inevitable 4 to 7 year cycle of downturns, the worse the cycle will eventually be. It's a little bit like not going to the doctor when you have a minor problem to discover that by waiting, you now have a big problem. So that's what we're facing.
So back in 1932, the Fed had pretty much, after the crash of October 1929, the Fed didn't do a great deal for a couple of years, and the economy just went to hell in a handbasket. And the week that FDR was sworn in March of 33, the last of the banks in America closed. I mean, it was just that complete collapse that you're talking about. He got us out of that, by and large, correct me if I'm wrong on this, by saying we're going to borrow a bunch of money and we're going to spend it putting people back to work. Because the way to get an economy working again is to put money in the pockets of people who will spend it, and that spending of wages will create demand in the marketplace, which will cause businesses to reopen to meet that demand. And that created kind of a virtuous cycle and then went into World War II, which was the ultimate government stimulus, that brought us 40, 50 years of relative prosperity. On the other hand, the Bush administration, when they were faced with a crash, said, we don't want to do what FDR did. That's what Democrats do. So we're going to use fiscal policy, or monetary policy instead of fiscal policy. We're going to use the Fed instead of the marketplace. Is that a reasonable description of the difference between these two approaches?
Absolutely. It's a question of how you divide your effort to save capitalism between monetary policy, which is what the banks and the rich people want, and they're hoping, which has been what happened, that money flows into the stock market, which is what the top 5% of our people count on in terms of wealth anyway. Fiscal policy helps the mass of people, not those at the top, in that disproportionate way.
And FDR's stimulus, by pouring all that money in, and then Eisenhower continued it with the Interstate Highway Program, and Kennedy, put a man on the moon. All of those programs produced long-term prosperity, and I think you could argue that setting us up for another great crash was probably mostly in 1999 blowing up Glass-Steagall, deregulating the banks, although there were a lot of other pieces. But so you could say that if we were to use the FDR strategy, we could at least have another 70 years of prosperity. But if we use the George W. Bush strategy, the Republican strategy, they use the Fed strategy, what's the end game? How do they get out of this?
They keep having to do the same thing. They have no end game. They have what you might call a continuing money flood game.
It's like we've become junkies.
Absolutely. They're dependent on all of this, and they're now focused in the short run on getting reelected. And then, there's a one of the great King Louis just before the French Revolution, when asked about the unsustainable money pumping spending that they did in the days of the French Empire, he had this famous line, "Après moi le déluge," which means in English, "After me comes the storm." Mr. Trump doesn't say it because he doesn't say things directly anyway, but that's his policy. He's just doing what is necessary. He didn't grab Mr. Powell by the lapels, but he did so figuratively. He got what he wanted. He got lower interest rates. You flood the economy. You boom the stock market. Not much else, but the stock market. And that'll get you through the next election. That's the perspective that they have. Meanwhile, and let me stress this, when you have a decade of the sort we've just had, with interest rates at or below zero much of the time, you have created a fantastic incentive for governments to borrow, for corporations to borrow, and for households who can't borrow much more because they can't sustain what they already have. I note that the default rate for college loans these days is 11%, which is unsustainable. You have now created a debt overhang, an excess of debt that we've never seen economically before. If we have a downturn now, the risk that it will be very severe is quadrupled because of the levels of debt. As companies have a difficulty, they will no longer just fold themselves, but they'll take with them all of the lenders whom they have tapped for this low interest debt. It is an extremely dangerous situation, papered over by looking at the stock market or unemployment numbers as if those two statistics dwarf or erase all else.